Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, an equity strategist for ADCB. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. Is the Russia-Ukraine situation going to escalate further? Are Western sanctions on Russia going to impact global growth? Is the Russia-Ukraine war going to exacerbate supply disruptions that have fueled inflation over the past year? Will corporate earnings be impacted by the sharp rise in costs? How will the Fed and other developed market central banks respond to the rise in consumer prices? Will the aggressive policy action bring the economic recovery to an end? Well, that's too many issues for investors to consider simultaneously. As such, financial markets are notorious for their inability to focus on more than one issue at a time. When multiple influences take hold, markets tend to turn very volatile thanks to the uncertainty around the range of outcomes possible for each of those influences. We think this is something that we've been experiencing over the recent weeks. In such a situation, what should investors do? The easiest option appears to be simply cashing out of the market and sitting on the sidelines. But we don't think this is prudent. Instead, we think a more suitable thing to do is to dial down the overall risk in portfolios and keep an eye on the timelines on which each of those market risks could play out. This could give some insight into the possible timeline on which one could add back portfolio risk. Obviously, at the moment, top of mind for investors is the heightened geopolitical risk situation in Russia and Ukraine. Whilst wars are great human tragedies, for investors it's important to let the judgment not come in the way of the objective assessment of the situation. On this, in the short term, while it is difficult to time the turn in the market sentiment, should the geopolitical tensions abate, financial markets could see a tactical bounce over the next weeks to months. As such, most geopolitical risk-off events of the past provided a good buying opportunity, with most risk assets recording a robust performance over the subsequent 12 months. In our view, the fundamental impact of any sharp rise in commodity prices due to disruptions and the implications of sanctions are likely to be felt over the next 12 to 18 months. Beyond that too, the impact of the war could be felt over the next several years in the form of higher defense spends, etc. Should geopolitical risks abate over the next weeks, the investor focus is likely to shift back to the problems that markets were dealing with before geopolitical tensions took hold. These include the concerns of slowing growth, persistent inflation, and tighter central bank policy. On this, as we've been pointing out in our recent podcasts, in aggregate, the global economy is moving from an early cycle phase into a mid-cycle environment, and arguably this cycle is moving much faster than normal. On top of that, this cycle is asynchronous across its global constituents, with Asian markets at a different place and pace than the West. So that makes this mid-cycle transition of a faster moving asynchronous cycle special but not without precedent. Such mid-cycle transitions in the past were usually associated with higher uncertainty and financial market volatility. However, as the cycle matures into a new normal, uncertainty should start to diminish and provide a reasonably clear path for financial markets. On the central bank policy, as we've been highlighting, we thought that the market pricing had moved to a hawkish extreme even before the geopolitical risks surfaced. However, recent weeks saw some moderation in market expectations of rate hikes and the balance sheet unwind by the US Fed. Even regarding policy at the European Central Bank, the expectations have now moderated somewhat. Yet, we think the key question to be asking is not on how many times or by how much the central banks are going to tighten, but rather if the policy changes are appropriate to the evolution of the growth inflation mix. Here, we believe that central banks are likely to stay on their course of policy normalization, but will remain vigilant of risks to growth and inflation. In that context, Fed's policy meeting in mid-March is likely to shed some light and thereby alleviate market concerns, at least in part. All this means headline volatility will remain high over the next couple of months, possibly paving a way for a better second half of the year. But in absence of concrete evidence of a recession, we think it is prudent to stay invested with an objective, diversified, and disciplined approach. Thanks for listening. In case you found this podcast useful, please do share it with a friend or a colleague. Also, if you'd like to get more information on what was discussed on this podcast and to understand near-term risks to your portfolios, please reach out to your contact at ADCB. You can also log on to our website www.adcbam.com for more information.